Welcome back to Canada Accounting Insights. If you've ever looked at a company's income statement and wondered what earnings per share actually means, or how accountants calculate it, this video is for you. Today we're breaking down basic earnings per share, EPS, under IAS 33, step by step, from what it is to how to compute it and why it matters to investors. Before we dive in, make sure to like this video, subscribe, and turn on the notification bell so you never miss our videos. All right, let's start with the basics. Earnings per share, or EPS, tells us how much of a company's profit is attributable to each common share. In simple terms, it answers the question, if the company earned X dollars this year, how much of that belongs to one common shareholder? EPS is a profitability indicator, and it's particularly important for publicly accountable enterprises under IFRS. That's why it appears right on the face of the Statement of Comprehensive Income, alongside net income. IAS 33 requires two types of EPS: basic EPS, which reflects actual shares outstanding during the year, and diluted EPS, which also considers potential shares, like stock options or convertible debt. In this video, we'll focus only on basic EPS, the foundation you must understand before tackling dilution later on. Now that we know what EPS represents, let's unpack how it's calculated, starting with the two key components: net earnings available to common shareholders and weighted average common shares outstanding, or WACSO. The first component is net earnings, or loss, available to common shareholders. We start with the company's profit or loss for the year, and then we subtract any dividends on preferred shares, since those belong to preferred shareholders, not the common ones. Formally, profit or loss minus dividends on preferred shares equals earnings available to common shareholders. But here's where it gets interesting. The type of preferred share determines how we make that deduction. Cumulative preferred shares. We subtract the current period's dividend entitlement, whether or not it's been declared or paid. Why? Because these shareholders must eventually receive every missed dividend before common shareholders get anything. Non-cumulative preferred shares. We subtract only what's actually declared during the year. If no dividend was declared, nothing gets deducted, even if the shares have a stated dividend rate. Let's make that concrete with a simple example. Imagine Maple Leaf Incorporated has $500,000 in 3% cumulative preferred shares and $1 million in 4% non-cumulative preferred shares. Its profit for the year is $2.3 million. For the cumulative preferreds, $500,000 times 3% equals $15,000. For the non-cumulative preferreds, assume $40,000 was declared during the year. So $2,300,000 minus $15,000 minus $40,000 equals $2,245,000 available to common shareholders. That's the numerator of our EPS formula. Now we've nailed down the top part of the formula, earnings available to common shareholders. Next, let's figure out how to determine the denominator, the weighted average common shares outstanding, or WACSO. This part measures how many common shares were effectively outstanding during the year. Companies issue or repurchase shares at different times, so we can't just use the year-end balance. Instead, we take a weighted average based on how long each group of shares was outstanding. Here's the basic idea. WACSO equals beginning shares plus issued shares times time outstanding minus repurchased shares times time outstanding. And there are two crucial adjustments to remember. Exclude treasury shares. These are issued but not outstanding, so they don't count. Adjust for stock splits and stock dividends. IAS 33 assumes these events happened at the beginning of the period, or even the earliest period presented, to keep EPS comparable across years. Let's look at an example. Suppose Aurora Corp had 60,000 common shares outstanding on January 1st, declared a 15% stock dividend on June 1st, and issued 10,000 new shares on October 1st. To compute WACSO, from January to May, the 60,000 shares are adjusted by the 15% stock dividend, giving 69,000 adjusted shares for 5 months. From June to September, those 69,000 shares remain for 4 months. Then from October to December, there are 79,000 shares for the final 3 months. When we weight each period, we get a total of about 71,500 shares. So even though Aurora ended the year with 79,000 shares, the weighted average for EPS purposes is lower because those extra shares weren't outstanding all year. Great. We now have both key inputs, earnings available to common shareholders and WACSO. Time to put them together. The formula for basic earnings per share is straightforward. Basic EPS equals net earnings available to common shareholders divided by weighted average common shares outstanding. Let's see it in action with a full example. Let's walk through Barrie Inc. example and do the complete calculation together. First the numerator, then the denominator, and finally the EPS. So step 1, net earnings available to common shareholders, numerator. For cumulative preferred, we deduct only the current year's entitlement, even if more was paid, because any prior year portion would have reduced the prior year's EPS. For non-cumulative, we deduct only what was declared this year. Start with net earnings, $1,325,000, less Class A, cumulative current year entitlement, 50,000 shares times $1 equals $50,000. Note that the other $50,000 paid relates to last year, so it doesn't reduce this year's EPS numerator. Less Class B, non-cumulative, declared $25,000, so the net earnings available to common shareholders are $1,325,000 minus $50,000 minus $25,000 equals $1,250,000. Step 2, weighted average common shares outstanding, WACSO denominator. IAS 33 requires that stock splits and stock dividends be treated as if they occurred at the beginning of the earliest period presented. Practically, that means apply a split factor to pre-split periods to keep EPS comparable. Treasury shares are excluded, time weight by months or days for precision. Now for WACSO, after adjusting for the stock split and time weighting, we end up with roughly 341,666 shares. Finally, the basic EPS equals 1,250,000 divided by 341,666 equals $3.66 per share. That's how you calculate basic earnings per share. Before we wrap up, let's reinforce how different corporate actions affect this calculation, especially stock dividends and splits. Always adjust for stock splits or stock dividends, even if they happen after year-end but before the financial statements are issued. Use months or days for weighting, depending on precision needed. Exclude treasury shares, they're not outstanding. Include contingently issuable shares only when all conditions have been met. And remember, under ASPE, EPS disclosure is not required since it applies only to public entities under IFRS. Let's recap everything we covered. EPS shows how much profit belongs to each common share. It's crucial for investors and analysts tracking profitability. The calculation follows: net earnings available to common shareholders divided by WACSO. Cumulative preferred dividends are deducted whether paid or not, non-cumulative ones only if declared. Stock dividends and splits are retroactively applied in the denominator. And that's the foundation for understanding IAS 33, basic earnings per share. If you found this breakdown helpful, give it a thumbs up, share it with your study group, and subscribe to Canada Accounting Insights for more practical, exam-oriented videos like this one. In the next video, we'll take this a step further and explore diluted EPS, where potential shares enter the picture. Thanks for watching, and see you in the next lesson.